So I'd like to share some failures with you guys today. I want you to listen to this following scenario, and I just want to know if it resonates with you. I want to know if you've shared a similar experience. So a while back, I had found a stock that looked so good. I was so excited to buy this stock, and I said to myself, I'm going to go ahead and do my due diligence. I'm going to do a lot of research on this company, and if things look good, then I'm going to go ahead and pull the trigger. So I researched the stock. I looked at some of its earnings, I looked at cash flow, I looked at some of the debt ratios. Everything seemed to be looking pretty good. They had beat earnings recently. I thought, this looks pretty good. So I flipped over to the charts. I was looking at the charts and I was seeing that it had been moving around. I was really focused on the price. The price was good. It meant I could buy more shares. I was kind of excited about it. I thought, maybe I can get some real good bang for my buck on this one. So then, of course, I flipped on CNBC and I started listening to what they were saying about some of the stocks that were in the news. And my stock popped up and they started talking about it. They started talking about a favorable forecast. They talked about earnings. They made things sound very rosy, very good. So I decided, yeah, I think it's time. So I flipped open my laptop, jumped into Thinkorswim, I placed the order on stock XYZ, and then for the next 2 weeks, that stock did nothing but go down. And it was so devastating for me because I had done so much homework, and then to have this stock just drop was horrific. So I'm wondering if any of you have had the same experience doing the research, watching television programs, reading blog posts, reading articles, trying to get as much information as you can, and then once you make your buy, the stock tanks on you. Then what happens, and maybe this happened to you too, but after the stock started to go down, then all of a sudden everybody was coming out saying, oh yeah, I would never buy that stock right now. This is definitely not the time to get in. You want to wait until blah, blah, blah. So then you just feel horrible because you're already down on the stock. And now people are telling you that, oh, it was so obvious not to get into the stock. So the reason why I'm shooting this video today is to share that experience with you, see if you've had a similar experience, and then I'm going to show you 5 key items, key tips that I use in order to evaluate and pick stocks now in 2019. The old me did it a different way. Since then, I've adjusted my approach, and I feel like these 5 key items help keep me out of trouble more often than not, and I just want to share them with you guys today. So again, don't trade anything based on my opinion. This is just me sharing what I do, my opinions on the stock market. These aren't predictive of anything that's going to happen. It's just what I like to do. So let's jump into these 5 key components of finding the perfect stock for you or for me. So let's start off with tip number 1, and that tip is using the 200-day simple moving average. So I have up right here a very simple chart, no indicators really, everything is minimal. You can see I've got volume down at the bottom, but I've got MongoDB brought up on the daily chart, and the only thing I have on this chart is the 200-day simple moving average. And I'm just going to highlight this green line right here is the 200 simple moving average. Now, the reason why I start off with this, and this is probably the most basic tool that I use, this is probably the easiest of the 5 steps to understand. I look for a 200 simple moving average that is trending up. I want to see it moving to the upside, and I want to see price action above the line. So you can see on this indicator, it is moving, this trend line is moving to the upside. If it were moving down, it would be moving in this direction. So I like this, that it's moving from left to right and it's moving up in price. If I hover down here, this is around $38, $39. If I hover up here, I'm up around $122. So we are moving to the upside. That is step number 1. And then the second part of this step is price action is above this line. If this price action were to drop below, then I would want to wait to see what's going to happen, because
then it could start to trend to the downside. I look for a trending upward 200-day simple moving average in combination with price action that is staying above the 200-day indicator. That's step number one. Let's move on into step number two now. All right, moving on. Here comes step number two, which is using the MACD. And MACD stands for Moving Average Convergence Divergence. And basically, what I use this for is I think about the MACD almost as a momentum rubber band. So if you look down here, this is the MACD indicator, and I'm just going to zoom in so you can see it a little better. But for example, pretend like this line in the middle of the MACD is sort of the unstretched rubber band. It's just relaxed. It's just straight and hanging out. Now, when momentum comes in and the stock price here starts to really jump and push up, you can see these green bars start to come in, and you can see these two moving average lines start to spike up. Now, what happens, what I think of this is the rubber band is being really stretched to the upside. So the more violent it is and the higher it goes, the more stretched that rubber band becomes. So when I'm looking for a position in a stock, if this is pushing up, then I know that that rubber band is going to have to then go from a stretched position to a relaxed position at some time. So volatility and circumstance can stretch it to the upside, but I know it's then going to relieve and come back to this midline. And I like to call this reversion to the mean. I like it when it reverts back to its unstretched state. So then you can see it starts to trend down and move down a little bit. And you can see it starts to push and stretch that rubber band down to the downside here. So then what's going to happen after it stretches to the downside for a while? It's then going to revert to the mean and relax the rubber band. So we came back to the mean. If we scroll ahead, we can come back here. You can see this drop right here. We had a push, a stretch to the downside, and then a reversion back to the mean. And that reversion back to the mean was, wasn't hugely significant. It was just back to here, but it's higher than where it was before. So this doesn't always have to obey this way. It can stretch, barely come back, and stretch more. It can keep going down, so it's not an absolute thing. But what I like to use it for is when the rubber band gets stretched to the downside and it's starting to show that it's contracting and coming back towards the mean, this is where I like to go ahead and take my long positions. It's also a spot where I like to options trade and sell put options. If you don't know what put options are, I'm going to make a video about that in the near future, so stay tuned. But just think of it as I want to get in at a low price because I want the stock to go higher. So I use this as, okay, we've stretched. Now I'm expecting over the next few days that we should now be starting to revert to the mean. And in this case, we do. We revert back up here to the mean. Now, moving beyond that, we don't know what's going to happen. So if you're wanting to get in long term, sometimes what I'll do is I'll actually come and look at the weekly chart, and I'll wait for one of these stretches to the downside on the weekly chart, or you can go to a monthly chart, however you want to do it. But just know that the larger the time frame you use, typically the longer the time will be that it's reverting back to its mean. So this could take weeks to get back to the mean. Whereas on the daily chart, if we go back to that, this could revert, in less than a week. Now I like to trade options, and I like to trade weekly options, bi-weekly options. So sometimes this shorter term daily chart works for me, but you could go out to the weekly chart or the monthly chart, or you could probably even go out to the yearly chart if you want and wait for a stretch on that time frame and then jump in as it's starting to revert back to its mean. It tends to minimize and stack the probabilities in my favor. It's less likely that it's going to continue going down than if I were, say, up here, overstretched. I know that if I stretch to the upside, I'm probably going to come back to the mean a little bit before going higher. So I just like to play it on the downside. Stretch down, get in, let it revert to the mean, and then go from there. So that's how I use the MACD, And I'm going to go ahead and link below in the description an Investopedia article on the MACD. And I'm also going to link an article on the 200 simple moving average that we just went over as well. So from step 2, let's move into step 3. Step 3, using volume to make sure that you have a liquid stock that's going to allow you to enter and exit easily without huge bid-ask spreads. Bid-ask spreads, I can link an article below, but you just want to make sure that that's tighter and closer together. That way you know your stock is more liquid. It's easy to enter, easy to exit. So where you can find your volume on your chart is right here. These bars right in here, and let me minimize the MACD. These are your volume bars, and this is the daily chart. So because we're on the daily chart, these are daily volume levels for every day that has occurred. Now what you can do in Thinkorswim is, as long as this bottom line right here, this little cross that follows my cursor, as long as I'm over this candle, you can see that I get a volume over here. If you watch right here, when I hover that candle, you can see 1,027,000 stock units, shares traded, exchanged. If I move to the left, 1,166. Move to the left, 1,299,000. And if I keep moving, I can see what's happening day to day. Now, for me personally, I like to trade stocks that have 500,000 and higher shares traded in a day. So if I come in here and I see 200, 100, 300, 800,000, then it goes back to 300,000, 200,000, I'll typically avoid that. Now, you can go to stock trading websites and you can look and you can find what their overall average trading volume is. But I just like to look, I like to just go through and look at the last couple weeks and just see what's been happening. Because, there might be something going on with the stock where volume is coming in and now it's over 500,000, but maybe a few months ago it was less than. I don't want that older data to necessarily make the decision for me. I want to be more relevant in the last few months looking at what the stock's been doing. And if you don't like hovering these candles and seeing that it has over a certain amount of volume for your liking, you can always flip over to your scanner. And this is just a random scan picked. I don't even know what it's for. Just a random scan. And if I go ahead and I scan for some stocks here, and you take a look at this list of scanned stocks, you can see on the far right hand side, I have volume set up. Now this just gives me the daily volume, and the reason for that is because I have it based on this daily time frame right here. Now if you want to add volume to your chart here, you can go into Customize, and Volume, you could search for it right here, and you can find whichever type of volume you want, and then you can add the item over, and that will place it on your chart here. So you can see, I can go back and say, oh, okay, volume, yesterday's volume was 16 million on Dell. I can come down here and say, let's look at some of the others. Only 925,000 on Euxin Limited. So it gives you a quick way to look at what yesterday's volume was. And now if you wanted average volume over a period of time, you can just add that to your chart as well. But my preference is to just look at the chart. I like to look at the size of the candles. I like to either hover the candles here and go back and look to the left and just look at the volume. And as long as I'm getting consistently above 500,000 shares traded in a day, that makes me comfortable with moving forward with this stock. It's another criteria, another checkbox met, so I know that I'm still on the right path with picking a winning stock. Now, I'm going to link an article to volume, so I'll have volume links below in an Investopedia article so you can read about volume and different types of volume. Investopedia is really good about discussing each and every one of these types, and you can get a better feel for it. So with that, let's dive on into step number 4. Okay, step number 4 is using a debt-cash ratio. I like to make sure that when I'm picking a stock, that stock has more cash than debt. Now, if they have no debt, that's excellent. If they have less debt than cash, that's even better. You can consider that like no debt is an A grade, more cash than debt is a B grade. If cash and debt are equal, you could call that a C grade. If debt becomes greater than cash, that's a D grade. And then anything below that, meaning like if, say, debt was 10 times what cash was, that'd be a failing F grade. I like to find stocks that are either an A grade, which means no debt, or a B grade, which would be that they have more cash than they do debt. So let's take a look at Zillow, for example. Now I'm in the TD Ameritrade's website where I have my accounts, and I'm just looking in here. I want to show you which numbers I go with. If you go to Fundamentals, this tab here, and you click on the balance sheet, you can come under Assets, and you can actually look in here and see cash and short-term investments. And we've got 1,440, and they display it in millions. So it's basically $1.44 billion. So once I have that cash number, then I want to know what is the debt number, and then I can divide the two and figure out what the percentage is. If I scroll down, I can get to liabilities. And under liabilities, there's a column for total debt. Now the total debt here is 1157. So let's put that in our calculator right here. Let's do 1157. So that's the total debt. And now I want to divide that number by the cash that we had. Cash and short-term investments, 1440. So let's divide that by 1,440. So that right there says that the debt to their cash is 80%. So this is good. So anything under 1.0 is a B grade. Now obviously, if this number were 40%, that's even better. So there are varying degrees of a B grade balance sheet in terms of cash to debt, in my opinion. So Zillow right now is kind of on the higher end. Maybe we would call this maybe like a B minus balance sheet. But any stock that has less than 1.0 is considered a B grade in my opinion. And when looking at stocks, if their balance sheet can have an A or a B, that tells me that if this stock gets beat up because of maybe a tweet from the president or some unfortunate news in another sector that kind of knocks everything down, or maybe even something like talking about trade with China. If that causes stocks to go down, I'm more likely to buy more shares at a discount on stocks that have an A or B grade balance sheet in terms of debt to cash. Now I want to give you one more example here. This is another stock that I just want to show you just because it's super interesting. So I'm going to go ahead and go to Fundamentals, and I'm going to click on the balance sheet. And when we come down here, we can see their cash and short-term investments, $48.596 billion. Now let's come to the liabilities. Total debt right here, 0. This is an A grade balance sheet. It is on our calculation would be a 0. This is Facebook right here, a 0. So this is ideal. So this tells me, in combination with other things, anytime Facebook gets beat up for things not related to Facebook, I tend to come in and nibble a few shares here and a few shares there because they have such a well-run company in terms of their overall bottom line and their balance sheet. Debt to cash is really favorable with Facebook. So keep your eye on A and B grade balance sheets, and it'll help point you in the right direction. I'm going to go ahead and link an article below in Investopedia on something related to cash to debt, and you can learn a little bit more there. So with that, let's jump into our fifth and final topic, and this is one of the most important, so stay tuned for it. We're going to talk about the PE ratio. Let's dive into it. And here's the fifth and final tip for picking your next winning stock, and that is the forward price to earnings ratio. I have an article here on Investopedia, and this is a really good article that helps break down what PE stands for is price to earnings. So the price of the stock divided by the earnings per share over the course of 12 months. So let's say a stock is $10 and the earnings on that stock for the entire 4 quarters adds up to $1. Then 10 divided by 1 would be a PE of 10. So this article will really break down how that works, and it gives you some really nice examples. Specifically this one here, a company has a current share price of $50 and the earnings per share are $5 for that year. Then the analysts estimate that the company's earnings will grow by 10% over the next fiscal year. The company has a current PE ratio of the $50 divided by the 5, which is 10. So then getting into the forward PE, the nice thing about this is it's based on estimates moving forward 12 months. So it's a forward-looking price to earnings ratio. And one really nice place to find this is if you go to seekingalpha.com. This is a really nice website for looking at forward PEs. And what I like about it is you type in any stock that you want and you can see right away PE forward 22.74. It's on the front page, so it's really easy to find. Now, the interesting thing about PEs is people try to break them down into, what's a good PE, what's a bad PE, and I've heard a lot of people say that anything under a 20 PE is really good. I've heard people say anything under a 15 is good. I try to think about, I like to say anything under 20 or 25, in my opinion, is a PE that's worth looking at. And it goes deeper than that, though. You can't just say a PE of 10, I'm going to go ahead and buy. What you have to do is look at someone else, another company in that sector, and compare its peers. So on Seeking Alpha, that's really easy. So for example, let's say you're really interested in trading Microsoft. And you bring that up on Seeking Alpha and you say, okay, $137, and let's look at its forward PE, which is 26.25. So after looking at that, you say, that's on the line. I want it to be under 25. I'm not really sure. Well, what you can do is just bring up a competitor. So Microsoft is 26.25. Now, let's bring up Apple. Let's see what one of its competitors looks like. It has a forward PE of 17.95, so an even lower PE. So it's showing that if you compare apples to apples, you can typically find what they'd like to call the best of breed. If you've funneled everything down, and now you're on step 5 and you're saying, okay, I'm in this sector, I like this area, I'm trying to decide which company within the same sector I want to go with. A lot of times, PE can, if they have everything else is equal, balance sheet, trend of the 200 simple moving average, volumes looking good, everything looks good, and you come down to the PE, you look at the forward price to earnings ratio, and one is at 17.95, and the other one is at 26.25, you might decide, okay, maybe Apple is the better buy right now. It's the less valued stock, which would be a better price. Some would say it's gone on sale just a bit. So that's one way of using the PE. That's the way I use the PE. I like to compare apples to apples with it, and it helps me make decisions on stocks for long-term investments and for options trading. And if I do, sometimes I'm looking for a stock and I bring it up and I see it has a huge PE, and it just immediately clues me in that, okay, I need to wait on this one. I need the PE to be less. This stock is overpriced now, and the odds are it's probably going to pull back and get cheaper before we go higher. So that's the way I kind of think about things and the way that I use the PE ratio. So there you go. There are the 5 tips for putting probabilities in your favor and maybe striking and maybe getting a stock for a really nice price and seeing some good growth in the near future. I want you to try to avoid that scenario that we just discussed, the experience that we've shared. I've had the same one, and I want to stack the deck in my favor so that the likelihood is that I'm going to get an increase in price when I do buy that stock and finally pull the trigger. So leave a comment below. Tell me about your experience. I just want to know if you guys have had this scenario play out with your stock trading, and how did you resolve that? Leave a message below. Let me know. If you liked the video, give me a thumbs up. And if you're new to the channel, consider subscribing. We'd love to have you stick around. Thanks for stopping by, and we'll see you tomorrow.